because I'm in the financial game, so to speak, and I've got a fairly broad reputation, everybody asks me, no matter where I go, whether I'm going to give a class, whether I'm giving a seminar, whether I'm giving a presentation, whether I'm going to a meeting, whether I'm meeting a new client. Actually, if I go to a party, everybody asks, what should I buy today? What will prices be tomorrow? What will they be like next week or next year? If one more person asks me about Bitcoin, I think I'm going to pull my hair out. But wouldn't investing or trading be easy if we knew the answers to these seemingly simple questions? If I knew the answers, I sure wouldn't be teaching. I would be just making tons of money. So if you're attending this class in the hopes that things like technical analysis has the answers to these questions, I'm afraid I have to disappoint you early. It doesn't. There is no super secret sauce out there. However, if you're attending this webinar with the hopes that technical analysis and financial learning will improve your investing, trading, or knowledge, then I have good news for you. That it surely will. Now, today we will be talking about a technical indicator, one that will help you understand the momentum of the market, where the asset is moving, whether it's trending, whether it's overbought or oversold. It is one of the most popular indicators out there. It's called the Moving Average Convergence Divergence. And it's the closest thing you're going to find to a secret weapon. Now, because the name is so long and complex, it's just referred to as MACD. Now, MACD was developed by Gerald Arpel in the late 70s. Now, those of you like me who are old enough to remember the financial world in the late 70s, all we really had was the stock market. We had the Chicago Board of Exchange, and we had some but there was no online trading, there was no retail, there was very little speculation. So the biggest market around and what everybody was developing things for, and there were no computers, there was no internet, was for the stock markets. And the markets moved a lot slower. I remember in the 70s, I was trading on the Chicago Board of Exchange. I traded agricultural, and we would be hand charting, and we had all the time in the world before the next price came in. You know, the only time we got excited was a couple minutes when the price fell or price raised, and we wanted to buy or sell, and we were up there, the pitch screaming, just like you see in the movies. Buy, 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 sell, sell, sell. But that lasted for just a minute or two. But it wasn't on information, it was just supply and demand. People wanted, the supply was limited, and they were demanding something. But MACD was developed to spot changes in the strength, direction, momentum, and the duration of a trend in a stock's price. Now, today, MACD is one of the most popular and broadly used indicators in Forex trading, as well as CFD trading, as well as in all forms of online trading. Now, remember, if you're an investor or you're looking at your 401k, technical analysis and technical indicators don't help you. Okay, because you're looking at more fundamentals. Will General Electric go up over the next 2 years? Okay. Now, you might want to trade Facebook because you think it's going to fall down or go up over the next few hours, and you want to buy it at 134 and sell it at 137 later after they make some announcement. But that becomes trading. Okay. And then indicators will work very well for you. If you're a swing trader, that means maybe you're going to buy Facebook and hold on to it for 90 or 120 days, but you're not going to hold on, put it in your retirement fund. Because in your retirement fund, you just want to see whether the dynamics, return on investment, and everything else will have Facebook climbing over the next 20 years till you're ready to retire. Now, the MACD indicator is typically placed at the bottom of the trading chart in a separate window beneath the price. The basics of a MACD are fairly simple. You start out with a 26 and a 12-day moving average. Okay, so let's go over to a live chart and let's take a look at how this is really done. So I don't have to give you all these words and you're just looking at words. Hold on a second. Let me pop my chart up here for you. Okay. Now, what you have on your screen is a live chart. Come on. Is a live chart for the euro US dollar. Not for any other reason except this is my standard teaching chart. We're not going to be talking about the euro and whether the euro should be going up or down. We're not even talking about where it's located, where it is, whether it's high, low. And we're using this for teaching. So MACD starts out with two moving averages, a 12 period and a 26 period. Why? Well, that's the formula Gerald Arpel developed for his MACD back in the 70s. Now, there are some people, there's some gurus out there that have their own little formula where you use a 22 and a 74 MACD moving averages. Okay, that's just them out there prophesizing about some way you should trade. The standard is a 12 period and a 26 period. So if you're looking on the screen right now, we have our 12 period moving average right here, and we have a 26 period moving average. Now remember, a moving average is pretty simple. We're using a 12 period moving average. We go back to the close for the last 12 periods. If we're looking at a 1 hour chart or a 30-minute chart, we go to the last 12 closes. So we're looking at a 1 hour chart. It's the last close of that period for each hour. So 1 o'clock, 2 o'clock, and we would go back 12 periods, add them together, and divide by 12. But MACD also uses what we call an exponential moving average. An EMA just gives a little bit more weight to the most current price because that's the most important price. So if you're looking at a 12 period EMA and you're looking at a half-hour candle, you're going back 6 hours ago. Is that price 6 hours ago as important as the price 15 minutes ago? No. So it gives a little bit more weight to that most current price. And so we take and put our, let me change the color so they're a little bit more contrasting for you. Let's make this a bright gold. Okay, so that's the gold line. Then we have the purple line. That's a 26 period moving average. But since we're using an EMA, as opposed to a simple moving average, so we have the gold line and we have the purple line, right? Follow along, you see them? Let me just highlight them for you. You know, at the end of each period, the numbers are recalculated, dots put on your chart, and the lines get connected together. The dots get connected and form the lines. Okay? And these are the moving averages. We refer to these as a fast and a slow moving average. Why? The 12 period, in any type of, whenever using more than one moving average, the shorter the period, the faster it reacts to price. So the shorter period, if you were using for some other purpose, a 5-day or 5 period moving average and a 10 period, the 5 period would be known as the faster moving average because it responds faster. So here we have the gold line is the faster moving average, that's the 12 period, and we have the 26 period. But if we were to say that is MACD, well, no, that really isn't. That's just called a moving average crossover strategy. It's a real basic strategy that's been around forever and a day. This is just the start of MACD. So MACD then takes the value of this line, whatever you multiplied and put together, put a dot on the chart, and subtracts from it the value of that line. So it subtracts the 12 period moving average from the 26 period moving average. And whatever the difference is, it plots it below on a chart. Okay? Pretty simple. 12 period minus 26 period, the difference is plotted on a chart. And that line on your chart is simply the difference of those two values up above. Okay. Now this line down below is based on a zero value. So anytime that the difference is above the zero, it's a positive number. And we know that 12 period is larger than the 26 period. Whenever it drops below the 0 line, we know the 12 period is smaller than the 26, because when you take a smaller number and subtract a larger number, you get a negative. And that's why it comes down below that 0 line. And guess what? Every time those two lines cross each other, like right here, guess what? It's at 0. Because when the two numbers are identical, they have to, so cross each other, they have to be identical. When they cross each other, what happens? One number subtracting the other number is always a 0. But again, if we were to use only this, that's still a moving average crossover. It's just a different way of seeing that. So we go on and add what's called the trigger line, the MACD trigger line. The MACD trigger line is a simple moving average of the value of the difference of these lines over a 9-period moving average. So MACD uses a 12 period, 26 period, and a 9 period. This other line, the 9-period moving average of the MACD line itself, is called a trigger line or a signal line. So what we have now below is their signal line, which is a 9-period value of the blue line. At this point, we no longer have the moving averages on a chart. Don't need them anymore. Don't ever put them there. Okay. I'm just showing you how these are derived, because MACD is automatic. You want to use MACD, you just click on MACD and it's automatically dropped on your chart. Now, the interpretation of MACD is when the signal line crosses the trigger line crosses the MACD line, it generates buy or sell signals. So in other words, if it crosses above, that means the trigger line, the orange line crosses above the MACD line, it's giving you a sell signal. If it crosses the opposite way, it's giving you a buy signal. So whichever way they cross each other gives you a signal to buy or sell. Now, one of the biggest drawbacks with MACD, and you have to keep in mind, is MACD does not care how many points you can make or is the trade going to go in your favor. MACD is saying there's a buy or a sell opportunity. It's not saying how long it's going to go or how far it's going to go. You have to use other pieces of information. It's just hitting you on the back of the head saying, hey, you have an opportunity here. Now, to make all this a little bit easier to read and see, we add what's called the MACD histogram. The MACD histogram is a visual representation of the MACD line and the MACD signal line. Because the histogram is also based on this 0 line right here. And again, in order to cross this 0 line, the trigger and the MACD line had to cross each other. Well, it's quite easy to understand which way they crossed, because what you got was a sell signal, and you can see it move down into a sell scenario. Here you got a crossover, and it was going up. So you get the cross in the opposite direction, and it was a buy signal. We can also judge the momentum of that move by the depth of the histogram. So basically, we can see how this histogram grew as price moved up, and as the price started to lose that momentum going up, so did our histogram. As price kind of sat here, MACD generated a sell signal. Although, so it wasn't enough for you to make any profit in a sell. But if you had bought down here when you got the buy signal, that's definitely where you would have gotten out of the market. So MACD gives you buy signals and sell signals or alerts. It tells you the momentum of the market, and it also tells you when the market's reaching overbought or oversold conditions. So you get a lot of information out of this indicator to make trading decisions. Now, a lot of people leave the signal line and the MACD line on their chart, and they use the entire thing. I, on the other hand, only use the histogram. It all tells you the same thing. But from this simple indicator, you have a ton of information that helps you in your decision-making capacity. So let's go back to my PowerPoint. So the MACD histogram is just a visual representation of the difference between the MACD and its 9-period EMA. The histogram is positive when the MACD is above the trigger line and negative when it's below. The moving average convergence and divergence indicator is both a momentum oscillator and a price-based oscillator. Is one of the most reliable studies that we have. While it's a lagging indicator, it works well in all time frames with all stocks, future contracts, CFDs, cryptocurrency, and currency pairs. It is a highly interpretive probability signal that is based on the differences existing between three moving averages, 26 period, 20, then 9. So remember, you're going to look for above zero, below zero crossovers. You're going to look for the depth of the momentum, or the momentum of the move by the depth of the move of the signal line and the MACD line, or by looking at the histogram. So remember, MACD gives you buy and sell alerts. What's an alert? It's a slap on the back of your head saying, here's an opportunity. So you have the three stories of MACD. You have crossovers, overbought and sold condition, you have divergence, and you have depth. So MACD is a 4-step derivative. The MACD histogram is an indicator of an indicator. In fact, MACD is also an indicator of an indicator. This means that the MACD histogram is 4 steps removed from the price of the underlying security. In other words, it is the 4th derivative of price. The first derivative is the 12-day or 12-period EMA, and the 26. Remember the purple and the gold lines on the top of the chart. So the second derivative is the difference between the 12 and the 26. Remember, we subtracted them and put it on the blue line in the bottom of the chart. Then we had the third derivative, which is the MACD signal line, which was the gold line we put on the bottom of the charts that crossed across the blue line. And the fourth derivative is the MACD histogram, which is the MACD less the signal line that forms the histogram. So the base of this indicator is the security's price, but it takes 4 steps to get the actual price to the histogram. Therefore, it is designed to anticipate signals in MACD, which in turn is designed to identify changes in price momentum of the underlying security. So remember, keep an eye on the center line. Remember, you're going to get a lot of false, not bad signals, false signals that there is a definite buy or sell opportunity, but it's not enough to cover your spread or not enough for you to enter the market and make enough profits. You can get whipsawed in and out. So traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets. Because MACD is not designed to tell you that you have it. It's telling you there's a move at foot, but it doesn't tell you how long that move is going to go. But it does tell you the momentum of the market, and momentum in charting is like momentum in physics. If you throw a ball in the air, it will ascend at a slower and slower pace the higher it projects. After monitoring the changing momentum, a person can determine when the ball will stop climbing and change direction and descend. So imagine that histogram is just that. It's telling you the momentum of the direction of that move. If it's a price is falling, it's telling you how much momentum it has and when it's losing momentum. Price is climbing, it's in the green, and you can see as it starts losing its momentum. So just like in physics, momentum changes occur before the price of an asset changes. So keep that in mind. And if you're going to start trading, just don't start trading. Just start learning. Look at a chart. Put MACD on the bottom and see if you can see the correlations between price moves and what MACD is telling you. And then come to our other classes. Slowly learn. But gaining knowledge is never a bad thing. So thank you very much and have a great trading day. Bye.